So I look at all of the spending, the budget, the AI, the onshoring as all a set of promises that are largely in excess of what you would normally need to have a stable economy. And so my question goes to who's creating the credit? How are these promises going to get funded? The Fed or commercial banks?
This episode is brought to you by Grayscale, your trusted gateway to more than 30 different crypto investment products. You'll hear more about them later in the episode. Nothing said on Forward Guidance is a recommendation to buy or sell any investments or products. This podcast is for informational purposes only, and the views expressed by anyone on the show are solely their opinions, not financial advice, or necessarily the views of Blockworks. Our hosts, guests, and the Blockworks team may hold positions in the companies, funds, or projects discussed. All right, everybody, welcome back to another episode of Forward Guidance, and Happy New Year. First recording here in 2026, and want to start it off with a bang here and get Andy Constan on from Dan Spring Advisors, repeat guest of the show. Andy, what's going on?
Hey, man. Good to see you.
Good to see you as well. I want to start with something that we've been going on back and forth about for the last couple months, and I think it's really important, and I think a lot of people are missing it. And you actually wrote in a recent report about how saying that going forward, central bank money creation will largely be a non-factor, and what matters going forward is credit creation and private sector bank money creation. So this is really interesting because I feel like over the past 10 years or so, there's been this cottage industry basically developed that is obsessing over flows in and out of the Fed balance sheet and, just endless acronyms. And that has been, people have called like the Fed the only game in town in terms of where, balance sheet and liquidity growth has occurred over the past decade. And it sounds like you're thinking that we're in this pretty major inflection point. So I'd love to just, walk us through how are you thinking about this major transition that you feel is happening?
I think the big thing to think about is that for the moment, and I think only unless there's a real economic crisis, which isn't in the doesn't seem to be in the cards, the activities of the central bank and to some extent the fiscal system, like the treasury departments of various countries, have really, which had dominated certainly since COVID, but even obviously in 2008 to the 2014 period, maybe even through 2018. Where those actions were really impactful at a minimum the securities markets, but more so on the broad economy. Where now the transition is to those things have calmed down to a fairly meaningful extent. We can talk about, and we will talk about, I'm sure, some of the specifics around that. But when I look at the future, I look at a significant amount of promises that have been made. Promises to build out data centers and fund the AI build out. That's a clear that you can't miss CapEx lately, and dominate and the returns of the various beneficiaries and spenders on AI. There's this other major set of promises that I would describe as promises to onshore production. And, we have this SCOTUS decision, which I guess looks like it's going to be announced on this Friday. Part of this whole tariff negotiation was a set of promises from what are essentially surplus countries who are major trade partners with us, and you can talk about scale, and allies, for making investments in the real economy in the United States to build manufacturing capabilities that is not part of AI. That's its own set of direct investment. And so that's a big new set of promises. And then, listen, generally, economies, for them to grow, certainly grow above trend, need to lever up. So that's always a factor. And then, of course, there's this ongoing fairly large relative to history federal deficit, which needs to get funded as well. So I look at all of the spending, the budget, the AI, the onshoring as all a set of promises that are largely in excess of what you would normally need to have a stable economy. My question goes to who's creating the credit? How are these promises going to get funded? And so with a central bank that is on the sidelines, with a fiscal authority that has its own issues regarding what it issues, that burden is likely to fall on the private sector. And so I think I'd like to get more in the weeds on that if we have some time.
Yeah, absolutely. We'll get in there in a sec. I do want to just contrast a little bit between this decade and the previous decade, because in that last decade of where I mentioned, people would say the Fed is the only game in town because that idea of promises being created, i.e. credit, was pretty lackluster in the 2010s. Commercial banks, no matter how many rounds of QE, like the thought was, we'll throw a bunch of QE, we'll stuff the banks with reserves, and eventually they'll be able to create loans that are backed by those reserves. But no matter how many reserves they gave to the commercial banks, we just really never saw that credit creation really get going again. And now it feels different. You're saying there's a whole subset of new promises being created, some by commercial banks and others by completely different nations. And I'm just curious, like, what do you see as the catalyst to this regime change from the 2010s to this decade?
Right. So, I mean, I think the big thing you're describing is push versus pull demand for credit. When you fill a bank with reserves and they don't need them, it doesn't change their behavior. In 2008 to 2013-ish, and to a small extent during the post-COVID, the large 2020 type stimuluses, banks were struggling to make credit, to create credit, because they themselves were impaired. And so when you take away an impairment, that does unlock credit creation. But when a bank is already able to create money, to create loans, to create credit, to print money, they're already able. They're just not willing. Making them more able at the margin may have some small impact, but it's not the same as convincing them to be willing. And the best way to convince a bank to lend money is to pay up for it. That's what they make them. They don't want to push money on the economy. They want to have money pulled from them. They want to be a price maker, not a price taker. And so how do you do that? You convince an economy to lever up, a private sector actor to say, I want to consume more, or I want to build a factory, or I want to invest broadly in the real economy. To some extent, I want to buy financial assets as well. All of those things pull banks to lever up. Pretty much as long as I can remember now, we've had an economy that credit growth has not been impaired by banks being unable. There's just been no demand.
If you're thinking about crypto investing but don't want to open a new account or manage keys and wallets, check out Grayscale. Grayscale has been offering trusted crypto investment products for over a decade, with 30 and plus counting, including single asset funds like Bitcoin and Ethereum, diversified portfolios, and thematic exposure to the broader digital asset space. Many of their products are available directly through your brokerage or IRA, just like a stock or ETF. Investing involves risks, including possible loss of principal. For more information and important disclosures, visit grayscale.com. As always, investments in blockchain technology involve risk, terms, and conditions apply. Do your own research. In considering with this contrast, so you have this framework that you've been talking a bit about in terms of looking at money and then also credit, and how, correct me if I'm wrong, but when the Fed was the only game in town in the 2010s, they were able to kind of do both things, like money and credit. But whereas now we're going into this regime where the Federal Reserve and monetary authorities are somewhat sidelined, but we're seeing credit creation, i.e. levering up, starting to occur in these other avenues. So I just Walk us through that framework of money versus credit and how it works in this new regime.
Right. So when I think about what matters to an economy, to financial markets, et cetera, it's three things. It's the creation of money, and we'll describe that in a moment, the creation of credit, which isn't money. It's just saying, hey, Felix, can I borrow some money? And you, who happen to have money, give me your money, and I now owe you that money back. The economy doesn't, there's no new money that was created. It's just, you gave me money and now I can spend it. You hadn't been spending it, so I've activated it. And we'll get to what that means. And then there's risk. What form is the credit creation and money creation taking? If you try to raise money by issuing a 30-year corporate bond, if you try to borrow using a 30-year corporate bond, that's a lot of risk for the lender to take on. You could default over the next 30 years. They're going to experience mark-to-market exposure as interest rates and credit spreads change. And so there's a certain amount of risk that they're willing to take. If you said, hey, I want to borrow money for a year, they're going to say, yeah, we got plenty of that. Here, have that. And so the borrower's choices on what he wants to borrow intersect with the lenders, which includes every saver and every bank, the lender's tolerance for risk. And so those have to clear market prices. And so that's broadly the three channels: creation of money, creation of credit, and then the risk of those various forms of credit and money as they hit the market. And so what we have is there's really two channels for creation of money: the Fed or central bank. I'm just going to speak about the US for here to keep it simple. The Fed or commercial banks. And those are the only entities that can create money. And they can literally create spendable deposits out of thin air. The way they do it is in the Fed's case, they buy financial assets, literally creating a reserve at a bank and a deposit from whomever the seller of that financial asset was, and that person can then spend that money. Now, a commercial bank doesn't need anything at all except a desire to take on risk and the regulatory capacity to take on risk. If I want to go in and borrow some money from a bank, I can say, hey, I'd like to borrow some money, and they can decide for whatever reason they want to, whether to say, okay, fine, we set on a price, and then boom, instantaneously, I have a bank deposit that I can spend in the real economy. And on the other side of the ledger, the bank has their asset is a loan that says, I'll promise to pay it back. And money gets instantaneously created that I can spend in the real economy that literally didn't exist. So money creation is powerful and has what you might expect. It allows instantaneous consumption, and it also creates more money, which has to be divided across all things. And so when money is created, all things, because nothing's changed with the things, and things are crypto, gold, stocks, bonds, and real economy stuff that you buy, all of those get debased by that creation of money. And so it has that impact. It also has a growth impact in that the bank, all of a sudden allows somebody who couldn't consume and invest to begin to consume and invest. And so that can be growth stimulative. And so, that's just generally the process of money creation, and it's highly stimulative. If it's given to people who will spend or invest in the real economy. If it's given to a bank, which, at some extent, some of the most recent changes in the reserve management operations that were announced in the fall is really given to banks. And like I said earlier, the banks don't need it. They're able to lend. They're able to lend. They're just not willing. So making them more able on the margin has a little bit of impact. But when you give money to the real economy, like real people who get money that they've borrowed, you get a stimulative impact on asset prices, on goods and services, and you get a debasement impact on being more money around. Now, credit creation doesn't require a bank. And let me just take you through that, because people definitely misunderstand what credit creation is. And they speak about things like the shadow banking system, which creates credit. If you have money and you want to lend it to me, you can lend it to me. We don't need a bank to do that. Just let me $100. So here I now have 100 of your bucks and you don't. You had a bank deposit, now I have a bank deposit. That's all that's happened in the real economy. But credit has been created, which, because I'm likely to spend that money more than you were likely to spend that money, creates a short-term stimulus that, when I have to pay it back, creates a short-term contraction. And so credit can be created, and it makes the economy more levered, more fragile to me not being able to pay you back. Because if I can't pay you back, then you're going to have some difficulties. Credit creation doesn't need money creation. Credit creation, when there is money creation, is quite attractive. And it's hard to create money without creating credit. Banks can't do it, for instance. For them, when they create credit, they create money. When the Fed creates money, they buy a bond from you, and now you have money. And so it's a slightly different thing. But the most stimulative money happens through a bank creating credit and money. Now, then we talk about risk. And how is the market overall taking on the combination of credit creation and money creation? And clearly, as I just said, before we did our $100 loan, the market was less, the aggregate society was less risky. And now it's more risky. As credit is created and as the economy gets more and more risky, prices change. People say, economy's a little more risky. There's quite a bit of leverage in the economy. I'm going to charge Andy a little bit more interest than I otherwise would. That's a framework I'd like to think about. And I think the important thing is that most folks think you have to have money creation because who's going to buy all this issuance? Like I just described a tremendous amount of promises that are going to need to people to let's just use hyperscalers for the moment, or data center investment. For a data center to be invested in, somebody has to come up with money. And so we saw Oracle fund it in the corporate bond market. We've seen all of the hyperscalers do it. Some are using their own cash flow. Some are reducing their potentially could reduce their share repurchase activity. Others may actually issue equity. So there's all this stuff that gets sold. Where does the money come from? How do people buy it? And so the answer to that is it comes from the spending that these people are doing. Like, just if you could just stop time and say, okay, here we are, T0, where are we going to be T1? And describe T1 as every dollar that was borrowed by a hyperscaler to build a data center has been spent, meaning NVIDIA got a chip, a utility got money to build their power plant. The guy that sells lunch to the construction workers got his money. Everybody's gotten their money. All the money's been spent. And now all of the money that has been spent has turned into someone's savings. And those savings fund the debt issuance. So there's a circle that is created by the credit creation, circles through the economy, and funds the spending. And so a lot of people are like, how are we going to fund all of this stuff? And the answer is from the spending. The problem is the timing of these things.
Something that you bring up a lot, and I think that people miss a lot, is that transaction, you always have to sell something to buy another thing. And I think that's where oftentimes people get hung up on, is they forget that, I need to sell this thing to go buy this thing. So if I'm going to buy that corporate bond that just got issued from a hyperscaler, I have to sell something else on the other side to actually make that transaction. And I think that's where you're going to explain the circularity of, that's always a loop of somebody selling something to buy another thing.
Right. And I'm at a higher level loop first, and then we'll drop down into that loop because it has a lot to do with how markets will trade. But the higher level loop is all that happened between when the hyperscaler builds a factory is the money they spent becomes somebody's savings. The savings are the things that fund the initial investment to begin with. That no new money had to be created for that money to roll through the economy. So that's the higher level thing. And so let's just speak to what that is. In order for you to buy a corporate bond from Oracle, you have to have a bank deposit. So this is down into a narrower loop. In order for you to buy a corporate bond from Oracle, you need to have a bank deposit. If you're fully invested, you don't have any bank deposits, right? So you have to sell something. Okay. So now let's say you sold a Microsoft bond because you happen to have some Microsoft bonds and Oracle selling theirs. And so you swap out of your Oracle bonds out of your Microsoft bonds into your Oracle bonds. Somebody had to buy them. So somebody else had to buy the Microsoft bonds. So now let's put ourselves in their shoes. Well, do they have a bank deposit? If not, they have to sell something. Okay, so let's say they sell some Microsoft shares. Well, who's going to buy the Microsoft shares? Well, do they have a bank deposit? Because if they don't have a bank deposit, they have to sell something. But one day, all that selling and funding and swaps into somebody using a bank deposit, or money gets created. In that case, somebody without a bank deposit who wants to buy, let's say straight away, wants to buy the Oracle bond, they can go to the bank and say, hey, loan me some money. I want to buy these Oracle bonds. And money gets created because the bank says, okay, fine. Give me the Oracle bond as collateral. I'll write you a loan. Here's your bank deposit. You go out, here's the loan. So our balance sheet has gotten levered up. Money has been created out of thin air. You go take the bank deposit. You buy the Oracle bond. You post it as collateral. Boom. Money's been created. You've borrowed some money and Oracle's borrowed some money. All those things have to get paid back, but money got created. And so ultimately, one way of having Oracle fund the future, make its investments, is to issue a corporate bond that somebody buys on leverage. And in that case, not only is credit created, but money's created. But it doesn't have to be that way. Money doesn't have to get created because of that loop I've described, where ultimately, let's just keep it really simple. Forget that Oracle's investing in a data center. Forget that. Let's use our favorite company, MicroStrategy. So they issue some stock. Okay, they're a seller of stock, and they're a buy, and they use the proceeds to buy Bitcoin. So somebody had Bitcoin, now has a bank deposit, and somebody who now has MicroStrategy doesn't have a bank deposit. Boom, the trade clears because maybe those somebodies are the same. And if they're different, it all loops back. And so whatever the investment is, even if it's in consumption, when credit is created, the consumption becomes somebody else's income and then somebody else's savings. And the savings are what fund the original loan. And so that circle always works unless the things that are being spent on, that we're spending money on, don't pay off. Don't pay off as promised. We invest in a data center, and for some reason the data center is not able to make profits and takes losses, can't cover its interest, and has to default. And that's how this circle breaks. In that case, you have a different circumstance, a different loop that we have to go through. But the point about all this is it's a matter of timing. That it's not something to say, gosh, credit creation is awful or lack of credit creation is awful. It just is. There's a circle, it works. But right now, what we have is a tremendous amount of T0 need for money and a period of time in which that money is going to be spent in the real economy before it becomes savings. And so in order for that to work out, so what does that mean? That means by and large, you'd expect the buyers of corporate bonds to say, hey, I'm getting a lot of risk on, I'm owning a lot more corporate bonds, I'm levering up with my bank, I'm doing repo with my bank. I'm feeling a little ill with the amount of stuff I'm getting. So I'm going to push that's causing me to have a higher threshold for the yield I need, and asset prices fall. At the same time, Oracle's taken that money and actually spending it in the real economy, creating growth, potentially creating inflation, though that's not certain, but creating growth, and you're getting a stimulative impact. So right now we're in the phase where we've got tremendous amount of money being spent in the real economy and tremendous supply of, this is how I see 2026, tremendous amount of money being spent on the real economy and tremendous supply of assets that someone's going to have to buy. And then, run 5 years from now, we'll see if any of this spending, this investing in data centers and onshoring pays off. And if it does, that'll easily allow the borrowers to repay. Or if it doesn't, then there'll be a credit crunch. But right now, all we have is a stimulative, supply-oriented thing. And I think that's where we're at today.
If you're thinking about buying crypto, but don't want the headache of setting up wallets or new accounts, Grayscale makes it simple. For over 10 years, Grayscale has helped investors gain secure, regulated exposure to crypto without the hassle of self-custody or opening new wallets. With over 30 investment products, from Bitcoin and Ethereum to diversified and thematic crypto baskets, Grayscale makes it easy to build a crypto allocation that fits your portfolio. Whether you're using a regular brokerage account or investing through an IRA, many of Grayscale's products are available right where you already invest. Investing involves risk, including possible loss of principal. For more information and important disclosures, visit grayscale.com. As always, investments in blockchain technology involve risk, terms, and conditions apply. Do your own research. Yeah, that was really great. And I'm just trying to think through what you described here of these circles, of these loops of leverage being created, credit growth from the private sector. It feels like it's just one of, like a natural law of nature, where this is how the economy is going through. And it's like, it's those classic kind of like Bridgewater-y frameworks of loops of, one person's spending, it's another person's income, et cetera, one of those. So it feels like we're going back to my framework at the beginning here. In the 2010s, the Fed was the only game in town, and they're just kind of pushing on a string, and none of this was really happening. And now we have this inflection point, and now things are happening again. And I'm curious, like, how much do you think of that is an intentional policy decision? Because when I look at what Scott Bessent says at the Treasury, he's writing op-eds about how, QE was a virus, and the Fed being the only, game in town for 10 years was a huge mistake, crowded out, and they became the only marginal increase of money. And he wants to deregulate the banks. He wants to get those traditional flywheels you just described to really start going again. And so just curious, like, how much of that do you think is an intentional policy decision?
Well, I think it's interesting. Like, my thinking is not full on this, and I'm also concerned it gets into sort of social issues. But I think it's quite clear, at least the consensus seems to be quite clear, that the impact of the balance sheet increase has been, particularly in post-COVID, when it also was brought together with actual spending by the government, where the government didn't just print money and say, hey, you guys are now more able than you were to create, you banks are now more able to stimulate the economy, lend. And the bank said, nobody wants to borrow. When the government actually spends the money, that takes the banks out of the picture, right? The money goes into the economy and stimulates. That was what we've seen in the last 5 years. And, certainly from 2008, I call it to mid to the mid 2010s. You saw that dynamic where banks, where the government pushed money in, but there wasn't an ability initially, and then once it was able, there wasn't really a demand side for borrowing from the real economy. So the question becomes, how do you get the real economy to want to borrow, right? I mean, ultimately, that's the issue. And the point I'm saying about the social issues is what happened when you have the push, the asset buying from QE, the all the deregulation issues, and then the government spending was a hard push. When what that did is it fed its way into asset prices more than it did into the real economy. And so when asset prices were inflated over this period of time, that impacted a small portion of the society. Let me be clear. It helped everybody, because when a company has low cost of financing, they're more likely to hire a person. Now, that's not going to give most, certainly in this country now, with the populist rage we're having from both sides, nobody's going to, no one looks at that and says, hey, if you hadn't done QE, would I have kept my job? No, you wouldn't have kept your job if they hadn't done QE. You would be in deep shit. But no one's paying attention to that counterfactual at this stage. But what did happen is we have this big asset inflation. It still doesn't answer the question of how do you get the economy to want to borrow to grow. So the answer to that generally has over the centuries has been when interest rates are adequately low, and demand turns, companies see that. They start selling a few more widgets than they had been, and they say, I think I'm going to build a widget factory. Interest rates are low. That allows the expansionary phase of and that's when people start glomming on to credit, issuing corporate bonds, borrowing from banks, and interest rates start to rise. We haven't really had that phase in a long, long time, but we're just beginning to. And this is, I guess, the essential point that I'm making is we're in the phase in which that is a real possibility. We know it's already happening in AI. We know there's a lot of promises to build to onshore production in the United States. There's a lot of promises to build out military in the rest of the world. Something's changed in that regard, without a doubt. The question is, are they good investments? Will they pay off? Well, with AI, I don't think it really matters right now whether they'll pay off. I mean, at some level it does, but the promises are being made, the order books are there, and the stuff is happening. I'm not sure about the rest of the promises. I'm not sure about the onshoring for productive capacity. I'm not sure yet that the military build will happen. I think some of that does have a lot to do with whether the tariffs actually are declared illegal, and so that Trump can use his influence with tariffs to get the domestic demand from foreign investment. But I don't see, for instance, more traditional levering up that would be an early cycle levering up from consumption. You're not seeing it in housing. You're not seeing it in capital goods, right? People aren't saying, hey, the conditions for me are improving. I can tell in my business that I'm working longer. The demands from my clients are higher. I'm writing more tickets. I'm selling more refrigerators. I'm selling more consulting services. I'm going to lever up and buy a car, or lever up and buy improve my home, or upscale my home to a newer home. We're not seeing that yet. And that's the sort of thing that I'd like to see kick in, but that'll just create additional pressure on interest rates and credit spreads to rise. But we're not seeing it yet.
I mean, couldn't you make the argument that it's a lagged effect where, the investment component of GDP goes first, and then ideally, eventually that trickles into consumption eventually?
Yeah, that's the way it works.
Yeah.
Right? And the consumption then also stimulates further investment until interest rates are so high that you can't afford the next marginal dollar of investing. It's too costly to raise, and then that's just the regular business cycle. But the last 18, 20 years have really damaged the normal business cycle.
I couldn't agree more. And I think this is like the zeitgeist. We've talked about this, where it feels like there's this whole world of macro pontificators, traders that are fighting the last war of the last 10 years, where it's like this obsession of what is the Fed doing with their balance sheet. You just saw it over the last couple of months, where everybody was going insane about the Fed going to buy bills again. Meanwhile, you just have we're going back to a traditional business cycle, it sounds like, and this is not a new thing you're talking about, these new circularities. It's just how the economy is supposed to kind of work, and it feels like people are still stuck fighting the last war.
Right. And so the question really becomes, and this is really, I think, the crux of it, right? So there's a couple of concerns I have with this particular set of promises creating what I would basically call animal spirits, cyclical animal spirits that convince consumers that they're better off, that convince consumers to that their jobs are safer, that their ability to borrow is, they are going to be able to pay back their loans, and get them to lever up for consumption purposes. We've got AI. It seems to me to be damaging to people's future job expectations. Now, that's one thing, so we'll come back to that briefly. But the other thing is, then there's this version of onshoring, and I am not a big fan of onshoring, because the reason why we aren't a manufacturing economy is because we're too expensive to manufacture here. And so if you force us to manufacture here, you're forcing us to create a less good for the money, or more expensive for the same good and service. And how's that gonna help? The way it helps is it improves national security. It improves the supply chain, the bulletproofness of the supply chain. And those are laudable goals for onshoring. On the other hand, it comes at a cost, and I like to think of that as more insurance costs. It's like, if you want these things, national security and a more robust supply chain in the case of a hurricane, or in case of a pandemic, that's fine, but it's a waste of money, because that insurance that you're spending is not going to pay off very often. And so, to me, I wonder how that's going to work in terms of the ability to get people to pay up for lesser goods, whether that'll work. So back to AI, I don't know. I guess it's possible that, so I think I've looked at these for hundreds of years, not me personally. I've looked over 100 of years. I'm old.
You're not that old.
I've looked over history, and technological innovations really have a really disruptive impact, and they work the same way. You get a major technology impact, and people become very concerned that they'll never work again, because their job is getting displaced by the technological advantage. And there is a period of transition, but in every case in history, people have figured it out. People have figured out how to then generate a different form of productivity, but real productivity that keeps them employed, keeps them earning, etc. So I'm hesitant to say this time is different. And I imagine, well, I was there during the internet age, and in a literal sense, I was alive and dealing with the potential fallout from the internet age, the information age, going back to the Excel spreadsheet, the Lotus 123 spreadsheet, and the displacement that would do. In that case, jobs came really quickly. They came with the technology, even though the technology hurt certain types of jobs. But throughout history, it appears that people were very, very, very concerned that they were never going to work again. And so I'm hesitant to say that somehow this time is different and that, in fact, AI will actually significantly reduce jobs, which itself will significantly reduce the desire for people to procreate, which will impact population. That's an extrapolation that people are always nervous about during this period of time and usually wrong about. But if they are wrong, that obviously has significant implications to social policy, et cetera. So I just mentioned that because I think it is true that during normal business cycles, what has caused the recession / slowdown is more about animal spirits, not about some other thing. And as soon as people start seeing interest rates low enough to, hey, I'm going to borrow. I see a little bit of demand. The policymakers are themselves spending a little bit, and they're trying to make it easier for me to do business through legislation. All those sort of things generally do create some, positive momentum and an upward focused cycle, an expansionary cycle. I'm not sure I see that in the current situation. So it means that we're depending on onshoring, which again may be wasted money, and AI, which may, for some period of transition, cause people to lose jobs. That isn't what I would say is the thing that is going to get me super excited as a business that isn't in AI, or a consumer who is threatened by AI to begin levering up. So I wonder if there is going to be that. And so now only these other things are pulling credit from the economy. For them to survive, eventually the consumer has to come behind and pull credit. And I'm just not sure they will. And so that's going to be the interesting dynamic. Right now, we know there's an investment pull that is going to create corporate bonds, equities, bank loans, and then get spent in the real economy. And then what? That next phase is, to me, where we are 2 to 3 years from now, where it better be the case that either the government steps in and things like UBI become a popular thing. To me, that's one path. And the other path is AI does replace us and we transition our jobs. But that's going to be, that's an unknown right now. And so the paying back, at some point, there's going to be hey, can we actually pay back all this investment? I think that happens before there's hey, this is the greatest thing. The economy is doing great. I want to lever up and consume. So that's sort of, my outlook as it would.
The last big question I want to unpack is, okay, so moving up to the aggregate, and you talking about the next year or so, this regime shift from going from public sector balance sheet growth or leverage to private sector balance sheet growth or leverage. I think the reason why a lot of active investors or traders are stuck in the last war, hesitant to accept this regime change, is because the last 10, 15 years has been very fantastic for all their financial assets. We've been able to have this, cake and eat it too, where we can have our stocks go up without inflation going up. And Now, obviously, the game is different, and there's this anxiety of, can we still have our cake and eat it too in this new regime? Can we still see equity indexes grind up every year in this new regime, despite the Fed being sidelined, despite that change from public sector balance sheet growth?
Right. So you described an interesting thing, which is the last 20 years, you really hadn't had to do anything at all except own assets. It didn't even matter which assets. Like, as long as you had a bunch of different assets, sure, some did better than others. But what happened is every asset inflated. Bonds, corporate bonds, stocks, gold, crypto, whatever, everything inflated. The world I just described, where there's lots of borrowing today for a hamburger in the future, where people are spending money, borrow today for a hamburger today. People are spending money today in the real economy, which is good for equities, good for GDP. It could be inflationary, depending on how aggressive the levering up is, but it's bullish growth. And it needs to be financed with borrowing. So that's bad for bonds. That's okay. It's okay for bonds not to underperform stocks and stocks be the asset you have to own, but you're not going to get both. And unless the levering up, with the money creation ending, only the private sector creating money, and that money getting activated in the real economy instead of financial assets, the debasement impulse of active central banks and levering that is used for financial assets shifting to inactive central banks and levering up that where the money goes into the real economy instead of the financial assets, that's a different dynamic. That means that, hey, gold, crypto, all those sort of things that did great don't do as great again. That it's really about growth. It's really about equities. And it's not about the rest of the asset classes. That's a world that I could easily see happening over the next year, right? So strong growth. Now, that's not my view, by the way. My view, we're talking about concepts right now. I'm trying to avoid pinning myself down to sort of like market calls and stuff like that, because literally by the end of the month, my views could change. But one real possible outcome of these promises is the money gets spent. And if the money gets spent, that's bad for bonds because it's getting spent in the real economy instead of financial assets. It's not asset inflationary. In fact, it requires asset sales to fund. So people need, but the real economy really benefits. And that can be good for stocks. Now, then you have to say, okay, well, what is stocks priced in? And listen, if we get 10% earnings growth this year, which is what's forecast, stocks are going to be up. I mean, even if you get even if all this issuance creates a two-handle multiple contraction, stocks are still up because that's 10% multiple correction and 10% earnings. And so it's pretty hard to be long-term bearish on stocks unless these promises don't get filled. Then what's happening? Nobody wants the credit. Nobody wants to borrow because the projects aren't working. Nobody does no foreigner sells their U.S. government bonds to buy a factory in North Carolina, which is a circle we didn't really talk about yet regarding how FDI gets funded. Like, all these promises require selling of government bonds at some level or levering up. If people don't do that, then the economy can really stall really quickly. And that's when you wonder what the Fed can do. And the market doesn't believe the Fed can cut, right? The market's priced for 3-ish cuts, a little less over the course of the next year. Trump wants a lot more. But the market's not saying, hey, that's what they expect at this stage. So the Fed's not set up to ease. 2-year notes have been the same yield for months now. There's no easing going on, no expectation of easing. Will they ease if these promises don't get filled? Yeah, for sure. For sure. But will that be enough? I don't think so. I think there's so much expectation in both earnings and asset prices that the Fed easing just won't be enough to offset that. So what we need is what the nirvana situation for me is all this spending, all this investment in the real economy gets funded at current level of interest rates and credit spreads, gets invested fairly rapidly and successfully, and keeps jobs, and that creates confidence, which creates ongoing spending, all of that. It's possible. And then you're going to have, bonds aren't going to make much because there's still plenty of them. But, as I said, the idea is that the interest rates that fund current debt don't go up. If they go up a lot, that's when you have projects being canceled, and that's when you get that negative loop. But it's possible that, there just could be so much demand for this real economy investment. The real economy investment pays off rapidly, and so people then have savings to reinvest. Banks get paid back rapidly. That's a pretty nirvana situation, but it also requires nobody to lose their jobs from it. So I think it's pretty unlikely, but at the same time, it's coming. Like, the spend is coming. And so when it ends, or when it's discounted to end, that's going to be the trick, because the order books are filled. The spending for the first half is coming. All manner of other positive things are occurring with OBBB, et cetera. There's a pretty strong growth impact. And you'd think that would hurt interest rates. And it is hurting interest rates. Like, the curve's as steep as it's been for a long time. Japan is suffering with very high interest rates relative to any history period. Germany's interest rates are high. The US, as I said, the US curve is fairly steep. Will that break? Maybe not. And if it doesn't, you have to wonder why that is. And it's going to have to be so disinflationary that rates can stay low. If it's neutral to inflation, rates are going to rise a little bit because it's going to be so pro-growth. So I think we're in a position where all of the funding of all of these promises is going to have an impact on interest rates. And that's going to slow the actual implementation of those promises, while at the same time, the likelihood that these promises, this AI investment, result in in more jobs or not less jobs seems low odds to me. And so I don't see the economy the rest of the economy, besides the ones that is hypercharged, doing particularly well.
Is the X factor here potentially like foreign capital flows? Because, like, if these promises need to get funded, and traditionally, like, the reason why, say, the US has been able to issue so much debt while keeping interest rates at a reasonable level is because we have an infinite bid from the rest of the world constantly. And is that why also there's this importance around the tariff ruling and what happens there because of those foreign capital flows?
Right. So let's talk about why there have been foreign capital flows and what the outlook for them is. So firstly, the reason why there's an infinite bid is because we keep buying their shit. And as long as we buy their stuff, they're going to use the money that we pay them for their stuff to buy assets. And that's why, as long as you run a trade deficit, which we do, and it isn't getting better despite tariffs in any meaningful way, there's going to be a bid for assets. So that's one thing. But that accrues over time. And that trade deficit already puts a bid into interest rates. It doesn't put an additional bid. But the promises are an additional promise. They aren't new. They aren't the same promises. We're going to do an extra $300 billion of FDI. How does that get funded? So the way that gets funded is the same way any funding occurs. They sell some financial asset that they already own in US dollars to give to invest in a factory. And the person who they sell that asset to has to sell an asset or borrow or have a deposit. The money, there's still no money creation. So one of the interesting things is all of the promises made by the Middle East, Japan, Korea, a few others, gets funded by selling government bonds. Ultimately, it gets funded by the ongoing trade deficit, but short term, it gets funded by selling government bonds, U.S. government bonds, because they can't raise the money any other way. You can't. Let me tell you something. The promises are far in excess of the amount of capital the banks could lend. Like, you talk about money creation, we're running about 10%, roughly 10% debt to capital to assets for the U.S. banking system. We were in severe stress at 8.5%. The total amount of assets that the banking system owns is around 20 trillion. I'm using very rough numbers. And so you have at most $2 trillion of credit creation from the U.S. banking system available. And the promises are in excess of that. So these promises are going to have a hard time being funded with money creation. They're all going to be funded with the circular selling of assets. And so foreigners are going to be selling U.S. treasuries to make, if they honor their promises, which they may not. If they honor their promises, that's the way it gets funded. Now, that said, their balance of payments isn't going to change unless the currency aggressively falls. So it's one possibility that the funding can happen by a large sell-off in the U.S. dollar against other currencies. Forget it, ignoring against non-fiat, but against these countries that are trying to borrow, that might incent them. But that FDI loop is all based on promises, and so you have to ask whether they'll honor their promises. Remember, I don't think it's a very good investment, and they don't either.
Mm-hmm. It's non-economic.
You have to think about the Hyundai and say, we could build a factory anywhere in the world today, including the U.S., and we choose not to do it in the U.S. And now, because Trump asked us, we're going to do it in the U.S. They were able to already make that investment, and they chose not to. So it must, by definition, not be a good investment. Now, the government may subsidize that investment in some way, and then it may be a great investment for South Korea, for Hyundai, but it's not a great investment for the U.S. taxpayer. This push, and again, it's just insurance. It's just saying we value national security and onshoring of production so that we don't have another pandemic-related supply problem. It's just saying that. And that's a perfectly reasonable thing to do, but it's not efficient. And so you wonder if these things are going to get funded. And I don't know. I honestly don't know whether they're going to get funded. And I think you have to think about, as you're thinking about markets and you're thinking about how to invest, you have to think about, okay, so what do you look for? And so I'm very, very conscious on the promises made, the actual spending associated with those promises, how's that spending getting funded, and what are the people that are funding doing to get the money to fund it? And then that dynamic can be played out in a highly detailed way with plenty of stats and data to track it. And I think that's what you have to do right now because, listen, I think it was pretty clear in September that data centers were the thing and everyone had to own all of the components of a data center build. That was one of the most popular investment theses of this early fall. It didn't work out at all. And it didn't work out the moment the data center debt came to market.
Yeah. Like what's Oracle? What's that data issuance trading at now?
I haven't looked today, but it's out. Their corporate bond that they sold at the time to issue. People look at the CDS. That's out around 70, 80 basis points from the tights. depending on which maturity you're looking at. I looked at the corporate bond. That's out 80 basis points. It's a meaningful change. And that change crushed CoreWeave, crushed all of the various hot data centers, and affected the broad world. And so, yeah, you have to pay attention to that stuff. Does that mean that AI spend is ended? No, not at all. It's going like crazy. It's like gangbuster spending. It's just a question of, what is the market doing to deal with this massive set of promises? How is the money getting spent? Who's lending it? And how's it being borrowed?
What's the market clearing price, and how does that affect everything?
Yeah. And how does that circle back into the likelihood that you'll continue to see that large spend? And as I said, this is one of those things. It's like the business cycle like this is always like this. Yeah. It's always like this. The two drivers of the major two drivers of the business cycle are AI and onshoring, and AI is potentially devastating to jobs. Unlike most investment cycles where you're building a factory to put workers in it, right? This is, you're building a factory to take workers out of it. Now, again, every technology does that. But then you look at the government already needs to finance a ton, and onshoring is a fairly, again, it's not happening yet, but onshoring is a fairly large supply of issuance. And you have to say, what's going to happen to interest rates and credit spreads? It's not bullish. It's hard to be bullish on credit spreads and long-term interest rates. And if you're not bullish on those things, that should just at least inform your understanding of what the economy is going to do.
100%. I think this was a very important conversation, a very unique one. I hope it gets people to rethink their priors and not get stuck in the last four. Like, there is this change now, and I don't know. You're much older than me. You've actually been there, but maybe it's a return to old school macro. It sort of feels that way a little bit in terms of just actually looking at the business cycles now. But I think it's important for people to digest and think about this whole dynamic of these circularities that we just discussed. So I appreciate you coming on and explaining it all.
Glad to be here.